Greetings from Finstudyclub. This is Ankur Kulshrestha welcoming all viewers to the first session on FRA. So this is really going to be one of its kind because you are starting your journey in the field of accounting. Now, this particular session and let's say a couple of sessions after that are all the more important for people who are looking at accounts for the first time in their lives. What I mean by that, now CFA is broadly a post graduation course which could be done even by people who did not have accounting in their graduation or let's say in their high schools. Now if that be the case, then the initial 3-4 video series that we are going to record from here on, starting from this particular topic, you will have to really pay a lot of importance to understand what is happening in the bigger picture. Not only that, you have to really kind of get outside the mindset that you are at a disadvantage. I've seen that over my experience of whatever 19 years that I've had, that sciences typically feel that they will never be able to do good in this subject. Now, please try and understand that FRA is 20% in level 1 and almost sometimes 25 and almost like 20% in level 2. So you can't really have a mental setback in 1/5 of your course. So therefore, please get out of that, should I say, the stigma that you have that you'll not be able to do well in FRA. And obviously, if you are a commerce or let's say you have already done accounts, maybe first 3-4 sessions are going to look a little redundant to you because we are really going to lay down foundation of what is account, what is an asset, what's a liability. Everything will be done from really the base level. Okay, so the initial 3-4 sessions that I have been saying are more relevant and suitable to a person who is really new to accounting. Okay, so let me start by giving you the overall flow of things. I mean, how does a thing or let's say the flow of information happens in the world of accounting. Now initially there is a business transaction which is done by the businessman. So here a corporate finance manager who is trained to take decisions, or let's say a businessman stroke promoter, these are the people who will really take a decision of, let's say, which machinery to purchase, where to take loan from, whether or not to make product at this price, so on and so forth. So there can be a lot of business transactions, 100,000 types of business transactions that will be done. Accountant does not have a say in that. Now, accounting comes into picture when this business transaction needs to be recorded for future reference. So it will be recorded. This is an incoming of information for the accountant. This process is called as accounting. Okay, now this is the way that any normal accountant would kind of record what has happened. But after proper recording, the accountant needs to tell back to the world. So this is an outgoing of the information that has been recorded. The accountant will have to tell back to the world as to what is the financial position of its business, what is the performance of the business, what is the liquidity position, obviously basis the information that he has recorded. So the process of telling back to the world is called as financial reporting. The difference between accounting and financial reporting is very clear. Accounting is the incoming, the initial recording part, and financial reporting, as the name suggests, you're reporting things to someone else. So that's the reporting aspect that I'm talking about. The CFA still doesn't come. So the stage 1 done by finance manager, stage 2 and 3 done by accountant, and stage 4 is where you come into the picture as an analyst. Now, analyst is supposed to analyze the information which has been presented by the accountant. A quick question I have for you. Will a CFA ever be able to look at the accounting aspects of any company? Answer is no. Because the reason for that is that no one would like to share the raw information with anyone outside. Every company will share the information only in the designed standardized format which is required by statute. Okay, so as a CFA, you have to really master how to read a balance sheet, P&L or a cash flow statement, and that's what we are going to do in my sessions in FRA. Okay. Now, point is, why is FRA being taught to an analyst? I mean, that's what my question. Looking at the weightage at which the FRA is being taught, in CFA, imagine 20%, which is almost one fifth of the course. One fifth time you are reading accounts. Whereas this course is not to make you an accountant, but to make you an analyst. Why is so much importance is being given to the accounting from an analyst standpoint? The reason for that is that anything and everything that an analyst does has to start from an accounting. I mean, if you are a credit analyst, how do you evaluate the credit capacity of any particular individual? If, let's say, as a parent you have to evaluate the performance of a subsidiary, you need the financial statements. If, let's say, as a stock market expert or as a portfolio manager, you need to identify certain companies that are mispriced, pretty much what you will do in your portfolio management in CFA, you will need a lot of accounting data. I mean, this is really a very short list. I mean, I can really raise these points up to 400. I mean, anything and everything that you do, as an analyst, has to start with the financial statement. You don't know what is happening with the other company unless and until you look at the accounts. I mean, the balance sheet, P&L, and cash flow, to be precise. So if, let's say, someone of you is already working as an analyst, maybe an equity analyst, maybe a credit analyst, maybe a fixed income analyst, doesn't matter, you would anyways be looking at a financial statement. So hence, I mean, you can't really question why FRA being taught so much. With that, I am coming to a lot of basics. Basically, this is really a very, very basic stuff, so all those commerces can really doze off, and my focus right now is on teaching the sciences as much. Now, my dear sciences, the world of accounting can be classified into 5 watertight compartments: assets, liabilities, and the balancing figure called as equity, incomes, and expenses. So, some of the things which you are already aware, let me not overcomplicate things. Income is something which is the principal revenue generation activity. So this is the answer if someone asks, why do you exist? Let's say if someone asks General Motors US, that Mr. General Motors, why do you exist? So General Motors is going to say that I exist to manufacture and sell cars. If someone asks Apple, why do you exist? So Apple is going to say, I'm a technology company and I want to manufacture products which help in telecommunication. So that part is the income for respective people. Now try and understand that a property seller is not at the same level as a property dealer stroke broker. Property seller wants to make money by selling the property at a higher price, whereas property dealer wants to make money by adding his commission. So if, let's say, $100, you add $10 of profit, 110 becomes the selling price, plus the $5 of commission, 115 becomes the final price to the consumer. So the income from a seller, the owner perspective, is this 10, whereas from a dealer perspective is this 5. Okay, so you have to very carefully identify the income. And I'm going to talk about income in a little more detail when I'm going to talk about your income statement. Expense, on the other hand, is the cost which is incurred to earn that income. As simple as that. I mean, you have to incur a lot of expenses to be able to earn that income. One of the example is, let's say I need to buy a laptop and a digipen and let's say a speakerphone to be able to record these lectures. So from let's say an IT company standpoint, an IT and education company standpoint, all these things are an expense for me. The internet connection bill that I'm going to get is an expense for me. Let's say the cost to buy raw material is an expense. Okay, so pretty much it's like simple. What is the asset, on the other hand? Now I want you to write these 4 words, okay, which is future, probable, economic, benefit. These are the 4 words that I want you to remember. Okay, asset is anything which is going to give you a future benefit, and obviously the benefit has to be in economic terms. We are not trying to talk about in a social welfare manner. I mean, we are anyways dealing with hardcore money. So anything and everything that is going to give you a benefit tomorrow or after 10 years, future, it could be very short term, it could be very long term, doesn't matter. It will be a short term asset versus a long term asset, but still it has to be futuristic. So anything that gives you a future benefit is an asset for you. On the other hand, liability is very similar. 3 words are same: future, probable, economic, but what is different is in place of benefit you have obligation. Okay, so anything that entails an outflow from my pocket tomorrow, or let's say after 10 years, is going to be called as a liability. Okay, if let's say I have $100 to be received from someone, that someone is an asset for me. I have to pay $40 to a second person, so that's a liability for me. The residual claim that I have belongs to the owners, something which is called as equity stroke preference share capital. This is what is the owner's equity. Here I want you to write 3-4 keywords and remember them also called as capital, also called as net worth, also called as net assets. Okay, so these are the three different words by which the owner's equity is also referred to as. Okay, some of the examples of revenues and expenses: sale of goods, gain on sale of investments, some of the other incomes, the non-operating stuff, income from services, depending on, and this list will be different from different company standpoint. What are the expenses? We are going to talk about each one. We are going to talk about each one in detail when I'll be talking about the income statement. Some of the examples of assets and liabilities: you have your cash and equivalents. Obviously you can use them to purchase anything tomorrow. Account receivable: group of people from whom you have to receive some money. Accounts payable, on the other hand, is group of people to whom you have to pay money. Okay, so that's the obligation versus the benefit. You have marketable security that we are going to discuss in balance sheet. Some things, the investments that you make for very short term, just to park the surplus funds and earn some short term return. You have something called as current asset. We are going to talk about that. Inventory, again, everything that we are mentioning here will be taken as a separate chapter later on. Then on the liability side, you have taxes payable, accrued liability, unearned revenue, all that jing bang. Just an important point here, I want you to make a couple of notings here. Accounts payable, just write short term plus write operational. And in case of notes payable, just write short term plus financial. You just write these two words. I know that I haven't explained them. I'm going to explain that in my cash flow topic, where it will be required to classify between the payments which are operational versus the payments which are financial. Yeah, I'm going to come back to it. So this is like really a base formation. Let's not get into too detailed aspect, from that standpoint. So with that brings me to, I think, one of the most important slide from a fundamental standpoint. And the slide may not be asked in the exam as much, but it is extremely critical from an understanding of financial accounts. If let's say $100 goes out of my pocket and results into no benefit for me, that outflow will be called technically as a loss. If $100 go out of my pocket and it resulted into some benefit, but that benefit has happened, has been a historical thing, nothing futuristic about it, I'm going to technically classify it as expenditure. So that means there is a difference between when you say that I've incurred an expense versus I have incurred a loss. When you say that you have incurred a loss, you haven't got any benefit for that matter. But when you say that you have incurred an expense, you say that I have got a benefit, but that benefit has happened, nothing futuristic about it. The third and a very important aspect is if a value outflow is going to give you a future benefit. Like I said, future benefit could be one day or it could be 10 years hence. Anything, but it has to be futuristic. That is something which is called as investment stroke an asset. Remember the definition that we have laid down from the point of view of assets. We have said asset is the future probable economic benefit. That's exactly what I'm trying to say here. That anything which is going to give you a future benefit is going to be called as an asset. Okay, I know this is not the right time, but I just want you to make a note of it. The genesis of depreciation is basically the movement of figure from here to here. Okay, just make a couple of recordings also. Just write P&L here, just write P&L here, and write balance sheet here. Okay, just I know this is not to be understood in great detail right now, but just like for hygiene factor, I'm just wanting you to mark a these things here. So I think with that I'm good to close my first session. There is a lot more coming up. Stay tuned for the second video on the initial basics part. So look forward to speak to you soon. Thank you very much. This was Uncle Kulsresh.